Going live. Noah, share your screen.
We are up. Hey, we are live. How about that? Some minor technical difficulties. Hope everybody out there's doing okay. Just a couple quick things here.
So we're live.
We are live. It feels that way.
Yeah,
just kind of scrambling here. We had some minor technical difficulties getting this launched this morning, so we appreciate y'all. I'm just trying to also get to where I can track it on YouTube so I can see everybody in there and who's chatting and whatnot. So hang tight one moment, see if I can get that to play nice. But good afternoon, everybody. Halftime report, or good morning, depending on where you're at. But welcome. We got an interesting, there we go, boom. I feel live and I just want to, I can hear myself. We're in good shape. Okay. Well, good morning, everybody. I feel like I actually can see everybody now and we're in good shape. We've got a lot of, and just tons of content today. I'm just going to be covering. And I just want to make sure we give a shout out to everybody who is here watching us live on YouTube. Starting out with, we've got myself, Noah Davidson, filling in for Matt and Tim. We also have Christian Sisson here, and shout out to Cody, who's running the show for us. So welcome. Going to start out here with this awesome tackle trading tweet. Do you even trade, bro? Do you even trade, bro? We had to explain this joke to Christian because, English is his second or third or fifth language. I don't know how many languages Christian speaks, but like 10 of them. But we had to sit and explain the nuances of the do you even trade, bro? It's like, do you even CrossFit, bro? So we just want to, again, welcome everybody out. I don't know who Mr. Hollywood is, but I'll take it if you're talking about me.
Okay, so, I laughed, Coach.
That's awesome. Okay. Oh, you mean Mr. Hollywood over here on the tackle trading meme? I thought you were talking to me. So, do you even trade, bro? Just use that in conversation anytime you get a chance. Because, when you're a trader, it's kind of like you're one of those people who does CrossFit. You can't stop talking about it, much to everybody else's chagrin. So we love trading. We love to talk about everything, that has to do with trading. We've got a ton of things we're going to be talking about today. Let's start out. Market's relatively tepid today, not really doing a lot. I've got the tackle trading skyline up. Can you guys all see that okay? Yes? Give me some feedback there in the chat if you can. Just want to make sure you're all seeing the screen okay. Okay. And we've got, kind of some mixed results here on the market. You can see when you look at a heat map, it just kind of gives you an overall picture of what you're seeing. I personally am always going to look at the chart of the S&P index, but it's always good, get a look at a heat map. I see more green than red, some neutral color black. And, you see some areas like you've got some of the basic materials, energy and oil stocks are down. So that whole sector is getting beat up a little bit. But everything else looks, on average, a little bit more green. If we switch gears and look at a chart of the S&P, let's go look at a chart of the S&P index here. And we just got a little bit of upward movement, very small upward candle right this moment in time. Not terribly surprising considering it's a Friday. Sometimes Fridays are pretty quiet. You'll see, short-term reversals in the market. A lot of traders don't like to enter new trades on Friday just because you're heading into a weekend. And, so far, typical volume on the morning. So nothing too exciting. Christian and I were talking prior to coming on. We were just kind of, going through what we were going to talk about in our typical routine and some of the things we wanted to talk about. News out there is relatively modest, not a lot going on. We had jobs reports, we had the payroll reports come out. We'll take a look at those in a minute. Some headlines, you got consumer staples boosted by Heinz and Kraft Heinz. China proposed some new tariffs on $60 billion worth of U.S. goods. And the conversation we were having is that a lot of the talk about tariffs doesn't seem to be affecting the market too much. And one of the things we talked about was that it seems like a lot of empty rhetoric surrounding tariffs, a lot of posturing. but the market seems to shake it off, not thinking about it. They talk about it a lot, but the market doesn't seem to pay too much attention to it. Unless we see, I think, more of the policies take effect, similar to what we saw in Europe. There's lots of talks about tariffs, but at the end of the day, they didn't really add any new tariffs. So that's kind of what we're looking at. I'm going to switch gears here real quick and go to Forex Factory. ForexFactory.com is one of those places where I go and track all the economic reports. So I'm on Forex Factory, you can see, and you go to their economic calendar, and you want to make sure you've got all the appropriate currencies checked. And we're looking at today's, economic reports here on Friday. And the first Friday of every month is a big one for economic reports. It's the non-farm payroll report and the jobs report, unemployment report. And you can see these numbers over here. And a lot of it just comes down to expectations. So when you're looking at this, I think what you want to look at is you want to understand how these columns work. And can you guys see this okay? I'm going to scroll all the way back up to the top. You can click on a graph and look at it. You can click on the details and look at that. So you got the little folder, gives you the details. On the right, you got the graph. But in the middle, you've got the previous report, the forecast, and then the actual on the left. And so you just keep that in mind as we scroll down to the bottom here. And as we're looking at the Friday's report, the big non-farms, employment change. The past was, you saw, 248,000. The forecast expectation was 191. We came in a little shy at 157. To put that into context, you click on the graph and you go look at the little graph, and it gives you an idea. They missed the expectation. The expectation was 191, and they came in shy at 157 on new jobs. So unemployment's low, but the unemployment change missed the mark. So that's a bit of a disappointment. And the best way to think about economic reports, it's like, waiting for Christmas morning, what you want. If you wanted a pony on Christmas morning and you didn't get a pony, you're a little bit disappointed. That expectation of 191, is obviously forecasted down from the prior report, but when they miss the market's a little bit disappointed. It didn't seem to overly affect it. The hourly earnings, the hourly average wage here, you can see that was actually forecasted to hit 3.3%, and they did. They hit the mark. So the report comes in right on the mark. So hourly wages are up. And the general idea is if people have money, especially on a payday like Friday, they spend money. And so these are the things the market's looking at. Those are the big reports coming out today. You had some ISM non-manufacturing, the PMI. And they had a forecast of 58.6. They came in a little shy at 55.7. And again, it just comes down to expectations. They expected them to hit that 58.6, and they came in shy at 55.7. The numbers there, I think, are relatively interesting. So, but at the end of the day, it's not even the numbers, the reports, it's the expectations. And did the market really react? So we look at the broad market, and we're seeing just a little upward movement in price. Do you guys think the market really put that much weight?
It's just another day in the office.
Just another day at the office, exactly. Just another day at the office. I just found myself wondering are you guys in any way, shape, or form hearing an audio loop?
No, for me, it's
just
normal.
Want to make sure. Yeah, I just wanted to make sure because I've got my headset on where I'm talking, but then Christian's coming in on a different set of speakers for me. So, market's pretty quiet. Not a lot going on the S&P. Let's take a look at the NASDAQ, NQ, and you've got a small body candle up here. I know most of you know what we call these little candlesticks. It's kind of doji-ish. Call it a spinning top type candle. After a big move up yesterday, the market's pretty flat in the tech sector. So we're seeing not a lot of major response. We've had a pretty big week. Apple topping that mark, making them worth the $1 trillion in market cap, and big move up yesterday. And then today is pretty quiet after the fact. Not a lot of new activity there.
So was it like a self-fulfilling prophecy?
You know what? Here's what it made me think of. I don't know if you saw this, but I believe it's Khloe Kardashian. I might be mistaken on that because I don't really follow the Kardashians. But I saw some report that she was like closest to being one of the first female billionaires. And you guys might be able to comment on that or no, but people literally started sending her money just to help her hit that mark.
Okay. So, yeah.
So my question was, did people buy into Apple just so they could see it hit that mark?
Just to see Tim Cook dancing.
Yeah. And so, you know, that's a big deal. The first company to hit $1 trillion. And I'm assuming it's going to come back. If you take a look at Apple's chart, you know, big pop up after earnings. From what I gathered on earnings, they had a couple things, like they had disappointing iPhone sales, but then they also, I think they've got some innovation coming down the pipeline. And we're seeing some of that upward movement in price still. But, you know, after seeing it pop up like that, you know, lots of energy, lots of upward movement. We see it slowing down a bit here on Friday. Again, volume's typical, just half of the day. But I would suspect it, you know, what goes up must come back down. Mm-hmm. So it'll be like, you know, just like Jeff Bezos is the richest man in the world temporarily, and then it comes back down and he's not. Then the stock price goes back up and he is the richest man in the world again, and then it comes back down and he's not. So it's one of those things. I think Apple, as of today, is $1 trillion company. Come next week, they might just be under that high water mark. So I think that that's a lot of general enthusiasm. You come back and look at their earnings report. They beat their earnings estimate. You know, the estimate was 222, and they came in at 234. And so, you know, you got a nice little gap up and an upward movement in price. They also are paying a dividend out here. And I think a lot of people hold on until they get the dividend. Then sometimes they sell afterwards, or when they pay the dividend, you'll see the price drop, usually the amount of the dividend. But after a big pop like that, I always wonder where the profit taking is going to occur. Was it Kyler? No, thanks, Adam. Yeah, thanks, Adam. I think you just lost your man card for that, knowing who Kylie Jenner was, but that's okay. We're still friends. So, but yeah, thanks for setting the record straight. You know, I want to make sure we're getting the right Kardashian the credit where credit's due. But TAC and NASDAQ, I think, look pretty quiet today. But, you know, some of it, you do have some of those big leaders there. Let's look at the Dow. Whoops. Let's check out the Dow YM. And it looks a lot like the S&P, a little bit of a drift down, some upward movement in price. Nothing too major. It did test that old resistance zone, breaking up above that, pulling back down with that kind of hammer-like candle. And again, I'd expect to see some upward movement in price off of this. But we'll keep
still we have a big resistance zone around the
lot of
26.
resistance out over 2580. Big resistance zone. This is a zone that it's trading in right now. If you kind of look at it, you can kind of see that I'm drawing that green line there. It's still in that zip code of that resistance zone. And so it could hang around there. And I'm not sure if you really count that as a full-blown break or not for that particular resistance zone, because it's tested it. And it's always, in my opinion, it's a zip code. It's not an exact price. So you can call it, you know, 25,448, or is it 25, you know, 500, somewhere in that ballpark. If you look back, you got some previous resistance in that neighborhood, and I'd say it's, you know, big fat number. The volumes gets a little quiet sometimes prior to breakouts. You can see the volumes kind of tapered down a bit. And today's volume, of course, is just partial day. But when you see that tapering of the volume, it's always like, okay, you know, you go first. Are you going to be the first one to buy into that and really believe that the Dow's off to the races? Let's take a look at the Russell 2000. And it's relatively sideways. You know, this has been previously, earlier in the year, been one of the hardest running indexes. And now we're just seeing a lot of sideways consolidation in here. And I would dare say that the rut's not sure whether it's coming and or going. One of the things I always pay close attention to, Christian, is seasonality. And if you're using the Thinkorswim platform, they already have it built in. And I'll just go back to the S&P, because that's, I think, if I had to choose one index, it's the S&P. I've got their little seasonality set up on the chart, and it gives you a good idea of what to expect this time of year. Now, to get the best view of this, what you do is you go to your chart settings, you go to your style, you go to your chart mode, and you go hit seasonality. I've already got that set up. And then the key is you want to go show a lot of history. You want to go show 20 years, you know, plus history. So I got it set to 20 years daily. I'm going to drop that out to 20 years weekly. And then what you're really after is the blue line's the current market value. You're looking at that red line down there. And to really get in and see that, you know what, I'm going to take it back to daily. Gives us a little bit more detail. I'm going to zoom in on this little red line down here. So you have to go to manual, and then you have to highlight just the little red line to get a good look at that. Let me get the highlight tool. There we go. Boom. And this gives you a pretty good picture. And this is something you'll see every week in the scouting report. Kind of shows you where we are. And here we are early in August. And the seasonal expectation for the market, you guys see that chart up okay? You guys see that yet? Yes? I know there's a small delay between the broadcast and the chat. But what I see, Christian, is this little downward move between August and October.
Mm-hmm.
That's my typical seasonal expectation for the market. And I look at that, and I kind of look at where we are here. What's today's date? August 3rd? August 2nd or 3rd?
August 3rd, yeah.
Yeah, okay. I wonder where this year's going. And I look at, August is one of the months where the market, July is one of the best months for the market. And then August tends to give some of that back. And it really all comes down to that October 15th tax date. That is when corporate taxes are due and when corporations report. Taxes are due on the 15th. And institutions will look at the market, and if they believe we're going to have a strong fourth quarter, they don't always offload stuff. But historically, whenever you hear about markets crashing, they're always talking about it in October. But that's when they just realized it happened. It actually started in August, got ugly in September. By mid-October, the markets, usually hit a bottom, and then it's back, and then it rallies back up. Now, I'm not suggesting that this year the market crashes, but what I am suggesting is seasonally, the expectation for August and September is not very bullish. So when you put that into context, I think that this year the market probably powers through, mostly because we've got increased GDP. The forecasts for GDP are good. Tax rates are lower. I don't think a lot of people are expecting, even though I think the market's overvalued from a fundamental perspective. We're just coming out of earnings season. And a good way of looking at this is if we were to go back and look at that market carpet and we go change the way we're looking at the market, we go look at earnings day performance. You had some companies miss, but across the board on earnings reports, how many big losers do you see? Facebook, Intel.
Yeah, Intel and Facebook.
WBA.
Yeah,
but I see a lot more green on the earnings than I do red. And so we've got a handful of obviously, companies that are still out that have yet to announce. If you go look at earnings day date, you can see, blue means they've reported, right? And pink means before, and if it's dark red, they have a ways out before they report. But I see we're mostly blue now. So I'd say we've got 80% of the companies are, in that ballpark, 75, 80% have reported.
Yeah, the great movers, market
big movers,
the big
caps, all the big caps have reported. And so when we look at that, and we come look at their earnings day performance, and you look at how they did, there's some black in there, but I also see more green than any other color. And so whenever I kind of try to get a feel for what that does to the PE ratio, if you look at like the cyclically adjusted PE ratio, that's something I pay attention to quarterly. I just kind of get a look at it. And after earnings is coming out, you can look at the Shiller PE ratio. And you can just search that out on Google, and you go find this little multiple website. It's got probably one of the best ones to look at, super easy. And you see a small downtick in the price to earnings ratio in the market. Now, 32 is overvalued. Anything over 30 is considered overvalued. So the price to earnings ratio across the board, the prices are high on paper assets. Historically, we've only been higher one other time. And this is something I always pay close attention to because it comes down to market valuations. This is going back to 1880 all the way out to current date. And you go to 32, and we've only been higher than 32 one other time in history. And that was when we were partying like it was 1999. which I think is really, really interesting. You know, it can go higher, but the crash of 2007 and 8, we had the Shiller PE around 27 or so. So the market's more overvalued than it was back in 2008. We've had a lot of easy money policies that have brought us here. But at the end of the day, are the companies still reporting favorable earnings? You know, we see that we got companies beating earnings. They're still showing us some money. And so when I come back and I look at the charts at the S&P, I wouldn't be surprised if we got a correction in the market, but I still expect a good fourth quarter.
Well, can you pull up the chart for the Russell 2000 for the same seasonality chart?
Yeah, for seasonality, you bet. In fact, most of them follow the same basic. And let me go to the index itself so you have plenty of data. The key is you have to go to an instrument that has all the data. Mm-hmm. And then again, you need to highlight just the blue lines, the current market. We already knew what that looked like. What we're after is that red line. So you have to go set it to manual so you can highlight it. And you'll see a very similar cycle on all the major indexes. It gets a little rough in August. September's better. October's, you know, this one's kind of down, up, down, and then fourth quarter. And my big takeaway whenever I look at the seasonality has always been this. Look, markets do really, really well from February through May. And then they have rough summer months, and then they do really, really well again in the fourth quarter. But right now, here we are, you know, in August, and what's today again, the 3rd. The Russell might be bottoming out by middle of August and then running back up towards September and then dipping for October. But it's generally when you look at the S&P index, that's a pretty good gauge. You can look at the NASDAQ and get similar looks on it. Let's look at the NASDAQ real quick. And same basic story here. You guys like the seasonality charts? Have you ever used these? You can use them on individual stocks too, by the way.
It's great. It's too bad Tastyworks doesn't have it yet.
Yeah, no. And the thing is the funny things about this, you know, Tastyworks is an awesome brokerage firm. They created Thinkorswim and then ran off and created Tastyworks, so they're still playing catch up on that. But NASDAQ tends to be chopping sideways September. It's not too rough. It's got a little downward channel, but that's based off of 20 years of history, and that's just that it's history. It's not, there's zero predictive value in it, but it gives you an idea of historical patterns, and it's averaged out. So some years are up, some years are down, but overall over 20 years, this, you know, gives you an idea of how the market treats things, and there are cycles to be aware of. You know, you can do it on an individual stock. So for example, we were talking earlier about US Steel, and you can see that, you know, from August through October, steel gets kind of beat up, but then it really, really rockets through December. So that's true for oil too. You go look at some of the basic materials like XLB, Basic Material Index, and let me go zoom in on that. And some sectors do better than others different times of years. There's an obvious seasonality to some of the things, but Basic Materials again tends to be kind of downtrend all summer, clear through to October, then it bottoms out and then runs up. If you look at the energy sector specifically, you'll see that's a little bit more pronounced in the energy sector, and oil specifically usually has a rough fall as you head into August, September. You know, here's the energy sector down, then it rallies from October to December. If we were to just look at the U.S. oil fund, yeah, you can actually see it without even really having to zoom in on that line too much already. You can already get an idea of where it's at. And just knowing that this is kind of a look at how institutions treat things. So from about the peak consumption of 4th of July weekend is usually when we hit peak oil consumption. And then it just drops through the rest of the year is how it tends to play out. Now that's, again, history. Doesn't mean there won't be some change in the current market cycles, but it gives you a good idea of what to expect out of certain areas of the market. So I use that often, you know, kind of to give us a bearing. But if we go back and we start looking at the major market indices, maybe we run through and look at the sectors real quick here. Let's go with, let's see what I got here. Broad market. I've got all the major indexes. Let's see. We've looked at US. We looked at the S&P. We'll go through the sectors here in a minute. We haven't looked at oil. Let's take a look at oil. Okay, so here's the expectation. Again, we see oil. We know that it tends to top out. All of a sudden, this pattern starts looking a little bit more like a head and shoulders. You can see I've got some random drawings on there. Let me go eliminate those. But we got our first lower high. So if I know that, my expectation on oil is that it peaks in July, this starts to me kind of feel like a little bit of a head and shoulders type pattern forming. And I wouldn't be surprised to see oil start taking a drop. So that's something to keep in mind. Let's take a look at gold. Gold continues to drop, and gold doesn't have a strong seasonal play to it. It just kind of does what it does. But gold is down. It broke some key support levels, and it's down here. 1200 is another big support zone. This is not something I love to get bearish on gold, but it's definitely trading down into new price zones. So if you want to look at that on a weekly time frame to get some perspective on that, 1200 is a big buy zone for it. And I don't know, that's a price threshold. And it's going to be very, I think, contingent on what the dollar does. So if we take a look at what's going on with the dollar index, dollar's rising. That's a weekly chart. Let me take it back into the daily time frame. And I see the dollar here kind of forming an ascending triangle. I expect the dollar to continue to rise just off of the interest rates alone. You've got the British pound has brought up their interest rate. If you go back to that Forex Factory website, I like that. That's got a lot of good stuff on there. You can just look at the interest rates. Tell me when you guys can see the interest rate picture on here.
I think that what's complicating with the pound, the British pound, is the Brexit thing.
Well, yeah, and it comes down to the Brexit and the austerity and kind of whether or not they're getting that. I think they fake Brexited is what it seems like. They're kind of kowtowing a little bit to the European Union there.
Sure, they're going to open the polls again,
Yeah. And, if you're looking at this from the interest rate perspective, the U.S., they're kind of sly. They say less than 2%, but the U.S. is now the leader of interest-bearing currencies. And the New Zealand dollar is not far behind. The Australian dollar is not far behind. The Canadian dollar is not far behind. The British pounds, now they've been able to raise rates, which makes that more attractive to hold. Like if you're an international corporation like Apple, for example, and you're sitting on mountains of cash, which currency are you going to hold them in now?
No, that's why emerging markets are suffering a lot.
Yeah. So, the dollar is kind of, again, reemerging. We've been able to raise rates slowly. The Fed's held off this last report this week, which Matt and Tim talked about at length. But the general idea is, again, that the U.S. dollar is still continuing to show rising. They've still got several rate, hikes planned. We'll see little quarter point rate hikes, that type of thing. And I'd expect by, beginning of next year, we'll be above that 2% mark, maybe close to 2.25, maybe close to 2.5. The higher the interest rates go, once they get those up to 5% ish, 5% is usually when you see that start to force the market tops in. So we've got a ways to go for that. And I'm kind of, this is my big question. Is we talked briefly about like the debt crisis prior to coming on. We were talking about it not just being it's kind of an international problem. The U.S., as it slowly continues to raise rates, if they raise them too quickly, that's going to cool off the economy too quickly. If they don't raise them, they won't be able to lower them to stimulate anything if we do hit recessionary type pressures. And so, for a while it was a race to the bottom and who could keep the cheapest currency. Euro still going at 0%. And so probably one of the most popular trades you could do right now is to hold the US dollar against the euro. And you can collect the difference in interest on the carry trade, which is a really powerful concept. And so it reminds me of a story I once heard many, many years ago. I think it was back in 2004 about Daimler Chrysler making more money on their money than they did manufacturing, selling, and financing cars. which it kind of comes down to is if you can hold the carry between like the dollar and the euro is paying no interest and the dollar is somewhere around 2%. That means you can make 2% on the leverage. You can use the leverage that they offer in Forex, and you can collect the interest on the leverage. So the carry trade is probably the most common trade in the world. And that just means that the demand for the US dollar should stay strong. And if you look at the dollar index, remember this dollar index is the dollar against, I think, 5 or 6 other major currency pairs. And so you're seeing that, continue to build some pressure. I'd expect the dollar to break out. I think that'll keep the price of gold down. I think that'll keep the price of oil down. And as again, we'll kind of keep an eye on that. That's as you see a strengthening dollar, that can have some diminishing effects on things like exports. Like if the dollar continues to get more expensive, exports go down. But it increases our ability to import, and so our purchasing power, internationally goes up. So there's trade-offs between a weak currency and a strong currency. And the U.S. I think is going to be, I've been pretty impressed with Jerome Powell. I think he's kind of towed the line, but he's been pretty pragmatic about his approach to the monetary policy. So I think that's really, really interesting. So as we, that takes care of all of our major market indexes. We didn't look at silver. That's going to track gold. Looks very similar. Big key support zone down there near 15. And looking at the VIX. Now, you've been trading for some time now, Christian.
Yeah, the VIX is as boring as
down there at 11.6.
It's horrible. It's boring as a bingo game.
Boring as a bingo. Well, I don't know where you play bingo, because when my Nana plays bingo, it's full contact bingo.
It's full.
Like those little
boring bingo. And the earnings season is great because we have lots of premium, but the VIX is just boring.
Not a lot of excitement there, and that's what you'd expect when the market stays strong. And so that's it's down. The VIX can go lower. If we see some volatility kick into the market, the VIX will pick up. If we see the seasonality pick up and we see August, September sell off, the VIX might get higher. But in the meantime, the premiums are pretty low. We're coming out of earnings season where you could get some premium. But that's kind of interesting to think about the VIX at 11. If it goes down below 10, you're in really cheap territory. And that makes some of your cash flow strategies slightly less effective. Not less effective per se, just less premium. And so it means you sometimes have to be slightly more, aggressive.
Just plain boring. That's boring.
Boring's a good word for it, but I've never heard that boring is a bingo game. That just made me smile.
No, maybe I'm playing the wrong bingo.
Well, yeah, it just depends on where you play. If you go to the right bingo parlor, I think you got a lot of good stuff in there. So let's see here.
Do you usually watch the Bitcoin versus the USD?
Well, we can check it. Do you have a particular index? We could just look at the futures. I don't know if there's a correct answer on that. Let's look at, what do we look at? /BTC.
Yeah, I think it's /BTC.
So I saw a little commentary by, was it Goldman Sachs this week, or I think it was Goldman Sachs or Bank of America, one of the big institutional banks, saying that the Bitcoin's going to die. I don't believe that for a minute, but Bitcoin has been kind of neutral-ish. It's been down, it's found some, but these swings are so big, between a low of 58.05 and a recent high of 8, you got a nice big swing in there. Higher lows, I think, are a strong sign for Bitcoin. The thing I always wonder about with cryptocurrencies is Bitcoin's got the most household name recognition, but there are a lot of other cryptocurrencies out there. And so I know a lot of people are interested in them, and there's lots and lots of them out there. You need to see Bitcoin really, it's kind of violated small-term trend. It's really got to get out and start taking out resistance points for me to really consider this a bottom. Because otherwise, the big major highs I'm seeing are still lower. So you could probably call that a little downward pressure there, and maybe it's forming kind of a descending type triangle if you look at it here with those lower highs. But if we start seeing it taking out resistance, I feel more confident that a bottom's come in. And I have not personally been a big Bitcoin player. I've been a little slow to adopt it. Well, if you use so the question came in from Dustin, what's the advantage/ditch advantage of charting the Bitcoin US dollar on Coinbase compared to, well, this is the futures. So futures are a derivative and it's tracking the price. It's based off of the underlying. But if you're trading the actual Bitcoin itself, you'd rather be tracking it on Coinbase, right? Use your Coinbase charts. So this is just a way I can track it inside of Thinkorswim without switching over to Coinbase. And it's like anything else, you know, the futures track the price of the asset, underlying asset, but there's some minor differences. So, but for an overall technical perspective, I would dare say that it's about the same. You know, if you're actually trading, obviously you use your charts in Coinbase. But for just tracking it, for just kind of looking at the overall ballpark picture, this certainly suffices. That answer your question well enough, Dustin? Great question, by the way. Okay, very good. Let's take a look at the major market indices. And so let's see if I've got my ETFs here. I'm trying to think of where I stashed my ETFs. Sector ETFs. Okay. So we can run through the S&P major ETFs. Basic materials to me looks pretty neutral. Seasonally, I expect it to drop, but that's a big old consolidation in there. So whenever I have a big consolidation type triangle, I don't know which way it's going any more than anybody else does. I've got a seasonal bias that's down, but that all depends on whatever else, you know, goes on with the market. Energy sector, we got kind of a high base here. My seasonal bias is down, but it would have to start breaking key support zones. So if it starts breaking resistance zones, I don't pay too much attention to seasonality. You trade what you see on the chart. But overall expectation for energy, for me, just knowing the seasonal history of it, is that it probably heads down. Financial sector, I think did really, really well off of earnings. They were some of the big winners out of this recent round of earnings. And it's been channeling kind of sideways. It's near resistance. I'm watching for a breakout on the financial sector. Industrials, very similar. It's trading near resistance. Had a really good run up off of earnings. And I'm looking for a breakout here. You know, it's range bound in that regard, but showing some strength, and we'll see if we can get a breakout out of that. Technology sector still seems relatively bullish. It's cleared new highs. It's just recently established new highs. You got some of the FANG stocks that are really driving that tech sector, you know, mixed bag of results on earnings. You had big hits by Apple, Amazon. You had some misses by Facebook and Netflix. I'm maintaining a cautiously bullish outlook on technology. Consumer staples has been rocketing up, and it's been clearing some resistance zones. And so I think we're off to the races with consumer staples. I'd say we've got a bullish bias on that. Okay. And then very cool, we've got real estate sector. And this is kind of your XLRE, your REITs. And it's showing some bullish strength. They have not been too adversely affected by the small rises in interest rates. I don't think it's gotten to a point where people slow down. You got a lot of overhead resistance out here at 34. I'm cautiously bullish on that. Watch for your $34 resistance. This is a time of year where you see a lot of real estate move.
So that's one thing that puzzles me, Coach, is that, for example, if you raise the interest rates and you would expect the financials to rally. But
well, the financials rally and real estate it cools down eventually, but they haven't really raised rates to the point where it's curbed borrowing. Once they get the interest rates, because we're talking about the federal funds rate is what we talk about with interest rates, and that gets, as those rise, you'll see that get passed on to consumers. But if you go look at like typical mortgage rates right now, they're still palatable. People are, the real estate markets are hot. Depending on where you live, like in some areas, they're overheated. And that happens when they keep interest rates too low for too long. it will slow down over time, but it hasn't quite gotten there yet. So they're just starting to see rates rise, but a lot of the markets are still running hot. So people are still willing to borrow. The higher the rates go, eventually the higher the mortgage rates go, then that means it'll cap prices. Like people won't be able to get as much leverage on the money. The debt service payments will be higher. They won't be able to afford as much home. And so prices will start to top out. But for now, they're still up. And this is there's a seasonal bias where most inventory moves spring and fall. And I think it has a lot to do with just the schools time of year, like people trying to move around, get their kids settled before school starts. So you see a lot of inventory moving in this August, September ballpark. Utility sector looks to me like a breakout. And this time of year, I would start looking at things like natural gas. Electricity tends to do okay too, but we're coming out of that heating, cooling season where you run ACs on your electrical utility, to where people switch over to anticipating natural gas for heating. Then again, depending on where you live and who your utility sector is, but they've also cut, they've done some of the, kind of changed some of the regulations, and they're seeing some cuts to cost of utilities, like actual, they're regulated. So we've seen some of the recent regulations force the utility companies to cut rates, and that can increase consumption, but can also curtail their profits. It looks bullish. I'm cautiously bullish at best on utilities. Healthcare is running up really hot. It's kind of got a rising wedge pattern. It's running, but I would expect it to top out. You got a lot of overhead resistance out here at 90 to 92. That whole zip code out there is a resistance zone, and just expect a correction and then probably more up. But that's something of interest. And then the consumer cyclicals, they've been running strong, and fourth quarter is always their best time of year. They cleared a big resistance zone, and so I'd still say cautiously bullish on the consumer cyclicals. So that's a pretty good overall look at the big picture broad market. Let me take a look here quickly at our agenda. We've looked at the employment report. We've talked about our markets. We haven't talked about some of the key stocks, and these are some of the things that we had from our scouting reports. From our stock report, I guess the couple of them we were talking about were Urban and AVGO. So let's take a look at those. URBN. Urban Outfitters, kind of a high base sideways chop. Very bullish trend. You got a time correction here. So you'll notice that I drew that trend line up, and I just ballparked that real quick. And you got this high base. And when the high base comes into that trend zone, that's usually a time when you can start to see it take off. Sometimes that could be like a 50-period moving average. I'd expect a breakout on that. Kind of a bull flag pattern in general with that high base, and it just needs to see it get up. It hasn't had much movement today. It's ended up turning into a doji, kind of a long upper shadow, which I wouldn't be surprised to see it come down and then take off. But interesting candidate. It's one that may take time. Fourth quarter, back to school certainly helps it. So there's definitely some perspective there. The next one on the list here from the stock report was AVGO. AVGO, big break of support, kind of a bearish move. You're starting to see it come in. Let me zoom in on this. This is a interesting spot for your bearish trades. You got downward confirmation, but it's hitting a support resistance zone right here. So, big context, bad miss on earnings, big support resistance zone, kiss goodbye, downward confirmation. This is the key spot right here. Yeah, start targeting at 200. That's a perfect target. So that works for a nice little target of 200. And here's kind of the beautiful thing about this. I haven't looked at AVGO. I didn't really look at the stock report myself this week. I was off in Mexico City and I got back. I've been recovering from Mexico City almost.
How are you feeling, Coach?
Yeah, I'm feeling pretty rough. If in case you didn't notice, let's listen here.
I can see.
I picked up a little Montezuma's Revenge down in Mexico City. Had a great time, but ooh-wee. Yeah, when they say don't drink the water, I think they mean it. This little price point in here, I think it breaks down. And so what I do on this is I take it down intraday. I look at this down on here. We got a 30-minute price scale. And let me see if I can go a little bit longer time. We got 10 days, 30 minutes. Let me back that out to 20 days or so we can see that support zone we're talking about. So here's the old resistance support zone we're talking about. And really what I want to see on this is the continued downward pressure on that zone. So that 210 support resistance zone, not really 210, it's 213. So 213 support resistance zone. We see that from the history. So here's, kind of 213, 214. We see it coming down, hitting that boom. I'd like to see this keep looking like an inverted cup and handle or a descending triangle as much as possible. This is where you might consider trailing your stop loss to break even. So if you got filled on confirmation here and you have a stop loss out here, it might be time to bring your stop loss down to break even. And it puts it a little tight. But once you get your stop loss to break even, you don't have a lot of stress in the trade. So if it did reverse on you, you're in okay shape. So I think those are great picks. Let's switch gears to some of the candidates from the options report. Let's take a look at AXP. And kind of a pullback down. This is still, I think, got a lot of bullish overall sentiment. But this is one where you're expecting the breakout here and you get a fake out. This is a textbook example of a fake out where it poked its head up above resistance just enough to get us triggered in. And if you got a retracement on that, it tested, kind of came down and retested one of the support zones. It might have cleared some stop losses, hit some stop losses. But in the big picture, has it really gone bearish, or is it still a building ascending triangle? Can you guys see my annotation on the chart? Coming in there okay? So now I don't know what Matt and Tim built out on this trade, if they did a directional stock or option trade, or if they did something like a call debit or something like that. But if this was coming from last week's scouting report, you got just enough of an upward movement to get you triggered in, and then it comes back down, Monday, Tuesday, Wednesday. And here you are kind of, you find yourself hoping that one recovers. I had that exact same scenario back here. I thought it was breaking out back in here as it was building, and it took a long time to get back out there again. It's having a real hard time with that 104 resistance zone. And once it breaks that 104, there's no doubt you want to be bullish on it. That's such a big price point. When big resistance zones fails, it's a very strong signal to buy. So what I like to do on candidates like this is I do like to leg into spreads or build out spreads. Sometimes I'll do things like broken wing butterflies if they price out right, where I can have a lower cost to take a stab at the bullish breakout and try to give it some time, because those are the kinds of things that could take some time to get to where they're going. Next on the options report, they had VMW and a little bit of a prolonged pullback into a support zone. Might have expected it to take off here at the gap. It's come down and retested. Now the fact that it came down that far and I think kind of violated that trend line might make that slightly less attractive. Doesn't mean it's going up, but do you guys see the little scribbles I drew on the chart? How it violated the trend zone? Had it stuck and rallied from the gap, it still holds the trend zone. But the fact that it came down to that same 140-ish support zone might just give you, it's not really a true violation of trend, but it certainly makes me think that it's not as strong as I thought when I initially spotted the trade. So take that with a grain of salt. I haven't looked at Microsoft this morning, but when I looked at it yesterday, I sure did like the chart. I thought that was about as a bull pullback as you can expect coming off of a nice earnings report. Little pullback down into a buy zone, little upward confirmation. Not a lot of movement today, but the whole market's been really quiet. So good overall candidate. I always like, the candidates off of the options report. We got those, obviously, the stock and option report and the futures and commodities or futures and commodities and the Forex report all coming out this week. Always excited to get those reports because they save me a ton of time. We've talked about crude light. We've talked about gold with the low base. Yeah, those reports I think are super, just incredibly valuable. And you don't obviously take every trade you find off of them, but boy, they do put up interesting candidates. And just to have that, go through the filter of one of our coaches, getting their picks, I think really helps. Helps me, one, because it saves me time and helps me make more trades. But it's also, I think, it's one of those things where it helps you train your eyes. Like how many of you are, when you watch those reports, learn a little something about the technical analysis approach? Like you get to see what they see. They in their little video, they give you an idea of why it wound up on the report. And it's not just a, hey, buy this stock or sell this stock. I see that kind of stuff all the time. I follow enough things on social media and whatnot where people are always throwing out, picks. Yeah, and so you get that. And I think it's really fine to, get random picks, but when you can actually sit and watch the video that shows you why it's on the report and what they saw in that, I think that's hugely helpful. Much more valuable than just a random stock pick. And, let's take from the commodities report, we talked about the low base on gold. Let's take a look at gold again, and let's back it out with some history here. Just because I think that 1200 zone is such a big price point for it. If you go back over history, 1200-ish is just a big number. If gold breaks 1200, I don't like shorting gold, but I would. I don't like shorting oil, but I will. When I was new to trading, one of my mentors, Jeff Crystal, he made me promise him not to short sell commodities like gold and oil and silver. But he just said that's just because over time they have nowhere to go but up. But in the short term, as your confidence builds as a trader, there's certainly times to short gold. There's certainly times to short oil. It just has to come down to you have to have a short-term expectation with good risk management, position sizing. And if you get a big commodity breaking a big key price threshold, it forces traders out. It hits stops. Because think about that. How many people have stop losses down below 1200? It's a big number. So if it hits, it kind of creates a big reaction, kind of a chain reaction on that. So I think those are interesting. I think if we switch gears and look at currencies real quick, one that I'm always interested in is the euro US dollar. And from the weekly perspective here, let's go to the daily perspective. I'm expecting the dollar to strengthen against the euro, which means that this is a low base. There's a huge opportunity for a breakdown here. So when we're looking at the dollar index, we're seeing that go up. But the euro dollar pair, I think you got a huge opportunity setting up for a breakdown. So that one I think is very, very interesting, and keep an eye out on your Forex report this week for that. And then the British pound US dollar. Let's take a look at that. Same basic story here. Now with the pound, managing to raise their rates a little bit, you got a pretty good support zone in this neighborhood. You're watching for either the double bottom to come up or for that to break that support zone. If it breaks the support zone, you can short that. If it finds some, support, I really wouldn't be a buyer until it broke that first resistance zone. But the U.S. is still going to continue to raise rates, probably at a faster rate than the Brits. And they still got a lot of Brexit questions where, their politicians can't seem to do what the voters asked them to do. And so I think you're going to see that breakdown. So looking for some confirmation on that. So that we've covered just about everything out there. And a couple of things we want to have you, looking out, checking out, and making sure, again, you're liking us here on YouTube. Have you guys stumbled across or found our definition videos that we're putting out? Have you guys seen those? Little definitions. Yep. They're super helpful. We're going to be producing those more and more for you. And right now, the one to check out would be What Are Higher Highs and Higher Lows by Matt Justice. I've done a couple on, what are options, in the money options, out of the money options, things of that nature. Just really good basic definitions. They're 2-minute videos. They're like 2-3 minute videos tops. Yeah, and so you get those. They're super helpful. Just keep and like them, watch them through the end. That helps us out. And so what I wanted to finish up with here today is I wanted Christian to help me out, and we wanted to talk about what to do when a trade goes bad. So we're going to finish up here. We both happen to have similar trade on U.S. Steel. So how many of you saw U.S. Steel's earnings report? Okay, so here's their earnings report. They beat earnings handily, but stock price dropped hard. Now, Christian and I have many things in common. Most of all, the fact that we're both somewhat bearded and good looking. But I happen to have covered calls on this. And I sold the covered calls because the premiums were high before earnings. And Christian sold naked puts right before earnings. And so we both had about the same basic risk graph. And the price is down. You got a little bit of a knee-jerk reaction. And from what I gathered, the earnings report was good, but then the CEO came on their call and kind of ran his mouth a bit. And market, they sometimes look for those keywords and sentiment and forward-looking statements. And I think some of the biggest concerns around steel are things like tariffs and trade deals. And so we see a big sell-off and it comes into a big support zone. So what I thought we'd go through is we'd look at some of the pain you'd experience. Now, let me show you the position I had on here. And this is a proud moment for a trader. When you go to your profit and loss column and you feel some significant pain. So I've got this, down $2,687 here, mirroring this in a virtual account. And that's 1,000 shares with some covered calls. The calls did just fine, made some money on the covered calls, but down on the asset. So I own the stock and down on the asset. Whereas, and let me go switch gears and look at the risk profile. This is my risk graph right here. I've got the covered call and it's gone well below my break-even point, clear down to 32. My break-even point was back here at 35 on the covered calls. And Christian has a naked put. Risk graphs look about the same, and he's just right below his break-even point.
Yeah.
On the naked put. So, Christian, you talked with me earlier a little bit about just the rules, and your position size is simple. You just got a single contract on that. Mm. It's a big support zone here at 32-ish, and that's the strike price. You sold a $33 strike.
Yeah.
Okay. What are your basic rules that you go through when selling that naked put before earnings gets you a nice premium? But what are your basic rules that allow you to? You mentioned that you feel pretty confident about this.
Yeah, the thing is that you have to have rules that you feel confident to pull the trigger or do not pull the trigger at all. So I always like to sell puts right before earnings because we have the juicy premiums. And then I sold it and then it gapped down the next day. That's okay.
Just in time. So you sell it the day before earnings, you get a nice premium, and then you get a knee-jerk reaction.
Yeah, get crushed. But that's okay, because if you're working around a concept inside a system, if you're working around a concept like I am working with my system, that's the real estate system, there is no bad omen. You can get assigned on US Steel and still be happy because you're going to cash flow, especially on the US Steel, because premiums are high. So I usually do that with this high premium stocks. I usually sell the puts before the earnings, and I really don't care if it gets in the money. But as you can see, the last earnings was the same thing.
Very, very similar. In fact, I was just going to comment on that. Got really
deja vu on the matrix.
Came down to that $32 price point and then rallied right back out. I would expect a similar outcome here, where it's come down. You already have your doji today.
Yeah,
I wouldn't be surprised to see that rally back out.
Well,
now, your trade with the naked puts, if it runs back up, you're fine. If it keeps going down, you face assignment. One of the things that you could do is, if it does end up breaking support is you could sell an in the money call and turn it into a short strangle. And I can roll my calls down, and I've got the calls are very profitable on my side. So if you wanted to roll your trade down, you can just roll your puts down and out, buy them back at a small loss, roll down to a lower strike price out in time and get a little bit more premium if you don't want assignment. But you say you're comfortable with assignment because you can still sell covered calls on it, right?
Yeah, sure.
Well,
But
that's how I wound up with these 1,000 shares, by the way. This was me selling 10 naked puts prior to or previous earnings announcement. So wound up with an exercise and assignment. And then I was able to turn around and start writing covered calls. So I got the $38 calls. And if we were to look at that, this is, I think, an interesting take. My calls are at maximum profit. They're not making any more money. If we do get a rally out of this, I don't know that I see it going up past 35, 36. So one of the things I can do to offset some of my risk is roll my calls down. So I can roll them down and out. I'll go analyze a rolling trade first and bring in some more premium. So I've got it here now where I can go, okay, let's go out. I'll probably go out towards 30 days again. So that would put me out towards 31 of August. And I'll be rolling my strike down to about 35 or so. I usually pick it off of a delta rule. So if I go 31 August and I'm rolling my call down and I'm picking like a 35 strike, my delta is 0.23. When I do covered calls, I'm usually 0.30 or less. I'm going to also take the technical perspective on it, and I don't see it going past 35. So I'm going to go ahead and take it at 35. And that would be an interesting little scenario there. So let's go set that one down to 35. That will put 41 cents times 10 contracts, so 410. So I want you to think about this from just a cash flow perspective. The trade feels like it's down 2,657, but if I bring in another 400 bucks, that offsets that. And then if I still own the asset and it runs back up, I'm actually in pretty good shape. So you look at the risk profile on this, incorporate the stock back into that equation. And once you get past expiration date here near term, let me roll this one forward here. I wind up and I'm still in a covered call with upside potential of 520 bucks. So I feel pretty good about that. I'll send that in. So here's what we'll leave you on a little note with. For your naked puts, Christian, if it breaks support, you can always take assignment. But one of my little secret weapons for naked puts, if it breaks below the key support zone and it breaks below, you collected 66 cents to promise to sell it at 33.
Yeah, that's right.
So if this support zone doesn't hold and it breaks down, how far down do you really see it going?
To the next support.
Probably 27.50,
yep.
somewhere in that ballpark. So there might be an opportunity for you if it breaks down. You could potentially, and you've got those of 24 August. So if I stick with those 24 Augusts, we'll have to look at the strikes and see what's available. You could sell $28 calls in the money, and you could collect about $4.35 out of them right now. Now, you promised to buy it at 33, but then you turn around and promise to sell it at 28. That means that the risk is $5, right?
Yep.
Well, if you collected 435 and 66, you'd be pretty close to break even. You're not quite there. You're coming in just a couple pennies off. Nope, actually, that puts us right in. That gives you're right at break even. You collect just enough money that if it goes below 33 but stays above 28, you collected enough premium here to offset the loss of the $5.
Great.
You can collect 440 and 66. That puts you $6 over the mark. And so you would then have a trade that could break even. Where if you sometimes face early assignment, most often not. But if it broke below that support zone and stayed down there, you can turn it into a short strangle. And then if it stays in this neighborhood, you'll win down here rather than just losing. But if it runs back up, which I think it's probably what it's going to do, I think it's going to run back up. But if it starts to break that support zone, you can consider turning it into a short strangle. That is pretty smart. Just a general concept. Did you guys have fun today? Halftime report. And I appreciate you being here with me, Christian, and for all your contributions. I've had a ton of fun being here with you. I'd say it's time to wrap it up because it's a Friday, and that closing bell's coming up soon enough. And I've got big plans this weekend to taking the kids out boating. So that's what I've got to go do. But I've enjoyed having y'all out here. This has been a lot of fun. And I hope to get to see you more and more on the halftime reports. And we'll see you all next time. We'll see y'all in the clubhouse. Okay, thanks, guys. Have a great.
Ciao.